Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 9, which covers manufacturing operations, and Chapter 10, which covers cost, volume, profit analysis. So as we learn about managerial accounting, in this question in particular, we are considering using what's called the high-low method. So the high-low method, that is essentially a technique for managerial accountants to use in order to estimate the mixed production costs at various levels of production by calculating the variable costs, and from there we can determine the fixed costs. So keep in mind that anytime we have costs, some costs are considered variable, which simply means that the total variable cost is ultimately dependent on the volume, and our fixed costs, those essentially remain constant. So here in this example, this is essentially when we have a mixed cost. That's when a portion of the total cost is both fixed as well as variable. That is considered a mixed cost. So here in this case, we want to use the high-low method. We want to determine what is the fixed cost for the month, or what are the fixed costs for the month. So given this information, we look at the months and we need to determine the highest and the lowest month. So the formula to determine the high-low method is as follows. It is the highest cost minus the lowest cost. And this is in our numerator. And then in our denominator, represents the highest units produced. We'll just say the highest hours in this case. So highest hours minus the lowest hours. All right, so based on this information, we see that our highest cost and our highest hours is for the month of May. And then from there, we see that our lowest cost and our lowest hours for the month of April. So based on this information, we can now put the formula together. And once we put this together, our highest cost minus our lowest cost divided by our highest hours minus our lowest hours, this gives us our estimated variable cost per unit. And from there, we can determine our total variable cost as well as our total fixed cost. So here we input the information. Our highest cost is $75,000 minus our lowest cost of $55,000. And the highest hours are 32,000 hours minus the lowest machine hours, 22,000 hours. All right, so we break it down even further. In our numerator, we have the 75,000 minus 55,000, which gives us 20,000. And we divide it by 32,000 minus 22,000, which gives us 10,000. All right, so based on this information, we'll pull out our calculator. And then here we see 20,000 divided by the 10,000, which gives us $2 per unit. So we have a variable cost of $2 per unit. So now for this problem, it's essentially asking us again, what are our fixed costs for the period? So we determined that it's $2 per unit. So now we need to determine, well, what is our fixed cost? So we know our total cost and we know our variable cost per unit, which is $2. Now from there, we'll determine what our fixed cost is. So we can use the highest month. So in this case, the highest machine hours was 32,000. We know there's a variable cost of 32,000 that represents the machine hours, and it's $2 per unit per hour in this case. So 32,000 multiplied by 2. That gives us 64,000 variable cost. And we know that in order to calculate our total cost equals our variable cost plus our fixed cost. So we can essentially do the reverse. Our total cost was 75,000 less, I'll put VC, our variable cost of 64,000. This would give us our fixed cost, FC, of 11,000. All right, so this is if we use the highest cost and the highest machine hours. We could also use this information to determine our fixed cost if we were to use the lowest cost and the lowest machine hours. So the machine hours in the second example is 22,000 machine hours multiplied by $2 per hour. That gives us a total of 44,000 for our variable cost. And in order to determine our fixed cost, it would be total cost of 55,000 less our VC, or variable cost, of 44,000. That would give us our fixed costs of $11,000. So again, you only need to choose one option. Either you can choose the highest to determine the total variable cost and to determine the fixed cost, or you can use the lowest. But the key thing is that we determine the variable cost is $2 per unit or $2 per hour, since we're using machine hours in this example. And we determined that our fixed cost, with no regard to if we use 22,000 machine hours or 32,000 machine hours over the relevant range, our fixed cost remains the same at 11,000. So therefore, the correct answer in this example is C, 11,000. And in the event that the question asked us to calculate the variable cost, the correct answer would be $2 per unit. So we'll move on to our next question. And this question asks us, reporting under managerial accounting is not restricted by specific rules such as generally accepted principles. So this is correct. So one key thing we know is managers that make numerous day-to-day operations. They make numerous decisions, rather, in line with the day-to-day operations of the business, in addition for planning for the future. So managerial accounting, it provides the information that is needed to make these decisions. So for example, management, they need to determine how many units of the product do they need to sell to make a product? What should be the selling price of the product? Should the company choose to stop selling a specific type of product? So because managerial accounting focuses on preparing information that is useful to management, it is not constrained by rules such as generally accepted accounting principles. So therefore, the correct answer is true. Managerial accounting is not restricted by specific rules such as generally accepted accounting principles. Next, we have this example, which shows us the relevant range in variable costs. So here it shows us Minibox Gaming Inc. manufactures components for computer games within a relevant range of 100,800 to 165,600 components per year. Within this range, the following partially completed manufacturing cost schedule has been prepared. So we have this range of 100,800, 128,800, and 165,600. So based on this range of how many components we produce, we want to determine what is our total variable cost, our total fixed cost, and we also want to determine the cost per unit. What is our variable cost per unit, fixed cost per unit, and our total cost per unit? So based on this information, we scroll down. Here we have our cost schedule. So one key thing that we keep in mind is that we know that our total variable cost is dependent on the number of components produced. So I'll put this information here to the right. And our variable cost, so our total variable cost equal variable cost per unit multiplied by components produced. So based on this information, we see that we're missing information if we manufactured 128,800 units, and if we manufactured 165,600 units. But here we have some key information that can help us to determine, well, what is our variable cost per unit? So we know our total variable cost per unit, and we know the components produced. So we can use this information to find out the information that we don't know, which is our variable cost per unit. So we pull out our calculator. We see that our total cost, our total variable cost was $41,328. And then we divide our total variable cost by the total components produced, which in this case is 100,800. So therefore, here we see that our variable cost per unit for each unit produced is 41 cents. And now the next thing is for us to determine, well, what is our fixed cost per unit? So our total fixed cost we see is $46,368, and we divide it by our components produced. And this gives us a fixed cost per unit of 46 cents. So the same way that we calculated our fixed costs per unit, and I'll just write some of these things here on the side so we can see how we calculate it. So we have variable cost per unit so our components produced times our variable cost per unit. So I'll put VCPU. So in order to determine our total variable cost, it is our components produced times our variable cost per unit. So we'll finish up with this first scenario. Our variable cost per unit was 41 cents per unit, and our fixed cost per unit is 46 cents per unit. So our total cost, if we were to produce 100,800 units, would be 87 cents per unit. Next, we move on to our next scenario where if we were to produce 128,800 units. So as we just pointed out, our total variable cost is determined based on our components produced multiplied by our variable cost per unit. So we get our calculator ready, and here we see 128,800 multiplied by 41 cents. So our total variable cost is $52,808. So $52,808. So the next thing we know is that our total fixed cost, this remains the same with no regard to the volume. So therefore, our fixed cost remains the same, whether we produce 100,800 units, 128,800 units, or 165,600 units, right? So with no regard to how many units we manufacture, our fixed cost remains the same of $46,368. All right, so we have this information now. We know both our variable costs. If we manufacture 128,800 units, we multiply the 128,800 units by 41 cents per unit, which gave us $52,808. And then from there, we add our fixed cost of $46,368. And that gives us a total cost of $99,176. So the next thing, we need to determine these costs per unit. So as mentioned, the variable cost per unit is not going to change. It remains 41 cents with no regard to how many units we produce. But what does change is the total variable cost. Now we look to our fixed cost per unit. So we see that our fixed cost per unit is ultimately dependent on the components produced. We know that our fixed cost remains the same. So our total fixed cost of $46,368 is divided by the components produced of 128,800. So therefore, our new fixed cost per unit, because we are manufacturing more units, is 36 cents per unit. So when we consider both, our total cost per unit now decreased from 87 cents to 77 cents per unit. All right, and one way to think about this is much like, let's say you went out to a dinner party and there were several people there. So let's say that you're having a large dinner, a large gathering. The total fixed cost is $46,368. If each person that comes, and in this case is 100,800, that means that for each person, we have to pay 46 cents per person to cover this total $46,368, right? Let's say we determine, hey, instead of 100,800 persons, we want 128,800 persons to be there. So based on this information, the total cost again remains the same, but now what does change is the number of individuals. So each person will need to cover 36 cents, right? So the more units we produce, our fixed cost per unit decreases. So now we move on to this example. And in this example, we are producing 165,600 units. We know that for each unit, it costs us 41 cents. So therefore, our variable cost, our total variable cost in this example is $67,896. So we have our $67,896. We add our total fixed cost of $46,368. And that gives us a total cost of $114,264. So now for the next part of the problem, we need to determine what is our fixed cost per unit. So as we mentioned, now instead of having 128,800 guests, we have 165,600 guests. So our fixed cost of $46,368 $368. We divide it by our components produced, which is 165,600. That gives us a cost of 28 cents per unit. So therefore, the total cost of this unit, if we were to manufacture 165,600 units, is 69 cents. All right, so that's just a key thing to keep in mind. Our total variable cost is our variable cost per unit multiplied by the components produced, and our fixed cost per unit is our total fixed cost divided by our components produced. So I know there's a lot of nuance with this question, but again, once you understand the basics of how our variable costs impact our total cost and how our variable cost per unit impacts our total variable cost, vice versa, same thing as it relates to our fixed cost, it'll make more sense. So I would strongly suggest continue to go through this problem to get a better understanding of the relevant range and how our total variable costs change in addition to the cost per unit. All right, so this brings us to the next question. Which of the following information is provided by job cost sheets? So with our job cost sheet, one of the main things that lets us know, how much is our direct materials, our direct labor, our factory overhead for a specific job is by using these job cost sheets. So with these job cost sheets, we don't know the manager's salary. We don't know the cost of depreciation on office computers, or the cost of utilities, but what we do know is the cost impact of material changes because we detail the total materials that are used for each job. So the correct answer for which of the following is provided by job cost sheets is the cost impact of material changes. For this problem, we have a job cost sheet, and it says McLean Furniture Company refinishes and reupholsters furniture. McLean Furniture uses a job order cost system. When a prospective customer asks for a price quote on a job, the estimated cost data are inserted on an unnumbered job cost sheet. If the offer is accepted, a number is assigned to the job, and the costs incurred are recorded in the usual manner on the job cost sheet. After the job is completed, reasons for the variances between the estimated and actual costs are noted on the sheet. The data are then available to management in evaluating the efficiency of operations and in preparing quotes on future jobs. So February 14, 20, year one, an estimate of $3,962 for reupholstering a chair and a couch was given to Marty McBride. The estimate was based on the following data. We have estimated direct material, 40 meters at $34 per meter for a total of $1,360. Estimated direct labor of 28 hours at $30 per hour for a total of $840. And here we see that our factory overhead is estimated, and it is 75% of our direct labor costs. So that gives us total estimated cost of $2,830. We have a 40% markup, so our total estimate is $3,962. And here it just says on February 17th, the chair and couch were picked up from the residence of Marty Bride, 6818 Gaines Ferry Road, Farley Branch, Georgia, with a commitment to return it on March 15th. The job was completed on March 9th. So it's asking us to complete the portion of the job cost sheet that would be prepared when the estimate is given to the customer, and to assign number 219 to the job, record the actual costs incurred, and to complete the job sheet. So here we see, with this example, we have our estimate, and then we also have the actual. So with this problem, we're simply just doing math. In the first part of the problem, here it lets us know that we had direct materials 40 meters at $34 per meter. So therefore, our total direct materials is $1,360 and our total is 1,360. We have no other materials that are being used for our estimate. Next, for our direct labor, we assume that it will be 28 hours worked at a rate of $30 per hour. So therefore, the total direct labor would be $840, and we bring it down, our total would be $840. So now we have our summary item. The summary for our direct materials is 1,360. For our direct labor, it is $840. And in order for us to determine our factory overhead, it is ultimately dependent on our estimated factory overhead rate. So if we scroll up, we see here that it says our estimated factory overhead is 75% of our direct labor cost. So if we scroll down, we see here our direct labor is $840. We get our calculator and we multiply $840 by 75%. So therefore, our factory overhead is $630. So now we need to determine what is our total cost. So we add our direct materials of 1,360 plus our direct labor of $840 plus our factory overhead of $630, which gives us a total cost of $2,830. So that's for our estimate. Now, if we consider our actual, we see here that we used 20 meters at $34 per meter for a total cost of $680. And then we used 24 meters at a cost of $34 per meter for a cost of $816. So now we add the two. We add the 20 meters at 34 and we add the 24 meters at 34, and that gives us a total of $1,496. So now the next part of the question is for us to determine our direct labor. So here we have Codina and we have Kirk. Codina worked for 14 hours at $30 per hour. That gives a cost of $420. And then Kirk worked 18 hours for a total, worked 18 hours at $30 per hour for a total of $540. So we add the two, our $540 for Kirk and our $420 for Codina, which gives us a total direct labor cost of $960. So the next part of the problem is us carrying over these totals to the summary item. So our total direct materials is 1,496. Our total direct labor that we carry over to the summary is 960. And then for our factory overhead, as we know, in order to determine the total for our factory overhead, it is based on 75% of our direct labor. So 960, we multiply by 75%, which gives us factory overhead of 720. So we add the three product costs, which is our direct materials of 1,496, plus our direct labor of 960, plus our factory overhead of 720, which gives us the total actual cost of $3,176. So again, the key thing is, multiplying each. In this case, we multiply our direct materials by the rate per material. We multiply our total hours worked, multiplied by the hourly rate. We carry over the totals. And then from there, our factory overhead in this example is 75% of our direct labor costs. All right, so this brings us to our next problem, and this deals with the break-even sales. So here we see Cold One Beverage Company reported the following operating information for a recent year in millions. We have net sales of $6,192,000, cost of goods sold of $1,548,000, gross profit of $4,644,000, selling, general, and admin expenses of $602,000. And we have operating income of $4,042,000. So it's asking, assume that Cold One sold 43 million barrels during a year. Variable costs were 70% of the cost of goods sold and 50% of selling, general, and administrative expenses, and that the remaining costs are fixed. For the following year, assume that Cole One expects pricing, variable costs per barrel, and fixed costs to remain constant, except that new distribution and general office facilities are expected to increase fixed costs by 22.96 million. So for part A, it's asking us to compute the break-even sales for barrels for the current year. So one thing we know about our break-even sales, the formula is as follows. Break-even sales equals our fixed costs divided by our unit contribution margin. All right. And one thing that we know is that our unit contribution margin, in order to determine what that is, it is our sales price minus the variable cost. So that is how we calculate the unit contribution margin. So in this example, there's some extra work that we need to do, but first things first, we need to determine what is our sales price for the unit. So in order for us to determine the sales price for the unit, we're going to use logic. So here we see that the net sales was 6,192,000. So we'll just do 6,192. And then it lets us know that we sold 43 million barrels. So if we divide our total net sales by the barrels sold, that lets us know that for each unit that we sold, it costs $1.44 per unit. So our sales price is $1.44. And again, how do we calculate that? It's 6,192,000. Now just put 6,192 divided by 43 million barrels. Right? And that is how we calculated our sales price. So now the next thing we need to do is to determine our variable cost. So in order to determine our variable cost, here the problem lets us know that variable costs were 70% of the cost of goods sold and 50% of selling, general, and administrative expenses. So we see that our cost of goods sold is 1,548,000. We multiply that by 70%, and that gives us 1,083,060. And then we divide it by the number of units we sold. So therefore, the variable cost for each unit is $25.20. And then it also lets us know that our variable costs are 50% of our selling, general, and administrative expenses. So therefore, our selling, general, and administrative is 602,000. We multiply it by 50%, which gives us 301, and we divide it by the 43 million barrels we sold. So therefore, our variable cost for our selling, general, and administrative expenses represents $7. So here we have our cost of goods sold, so COGS, and then we have our SG&A. These represent our variable costs. So when we consider this, we add it together, the 7 plus the $25.20. We get a total variable cost of $32.20. $32.20. So now our unit contribution margin is the sales price of $144 minus our total variable cost of $32.20. So when we do the math, we get a unit contribution margin of $109.80. So $109.80. And then the next thing is we need to determine, well, what is our fixed cost? So I want you guys to think logically. Here in the problem, it lets us know that variable costs were 70% of the cost of goods sold. So that would let us know that the other 30% of our cost of goods sold represents our fixed costs, and 50% of our selling and general and admin expenses represents our fixed costs. So we would determine our total fixed cost as follows. 1,548,000 multiplied by 30% gives us $464.40. So $464.40 plus the 50% of our selling, general, and administrative expenses. We will calculate it as follows. 602 multiplied by 50% gives us 301. So 301. So we simply add the two. 301 plus the 464.40. That gives us a total of $765.40. So $765.40. And then we divide it by our unit contribution margin of $1.80. So $765.40 divided by 109.80. And this lets us know that we need to sell 6.97 million barrels. So 6.97 million barrels. And I'll actually write it in. So 6.97 million barrels. So now it's asking us to compute the anticipated break-even sales for the following year. And now this is assuming that in addition to our already known fixed cost of $765.40, or let's just make it easier, $765.40, they also expected to increase by 22.96 million. So based on this information, our numerator changes. It's our current fixed cost of $765.40 plus the expected increase of 22.96. That gives us a total fixed cost of $788.36. And we divide it by our contribution margin, which we've already calculated, of 109.80. And that lets us know that in the event that we do, have these additional expenses, instead of only having to sell 6.97 barrels, we now need to sell 7.18 barrels. So we round it. All right. So as we go through this example, the key thing to keep in mind is that in order to determine our unit contribution margin, the first thing we need to do is to determine our sales price. And we determine our sales price by dividing our net sales by the amount of units that were sold during the year. So that is how we calculated this $144. We simply divided 6,192,000 divided by 43 million barrels gave us a sales price of $144. And then from there, we determined our variable costs. It let us know that variable costs were 70% of cost of goods sold. So we have our cost of goods sold amount here, which is 1,548,000. We multiply it by 70%. And then we divide this total by the barrels sold, which is 43. And that gave us a variable cost of $25.20 per unit, as we see here. And then we did the same thing for our selling, general, and administrative expenses. It says 602, and 50% of that represents our variable cost. So this total we divided by the number of barrels sold, and that gave us a variable cost of $7 per selling and general administrative expenses. So we added the two, 7 plus 25.20, which gave us our variable cost of $32.20. And that is how we determine our unit contribution margin, $144 selling price minus the variable cost of $32.20. All right, so there should be 111.80. All right, so with this new change, our numbers would change as follows: 765.40 divided by 111.80. So in this case, we would need to sell 6.85 units. And for B, we compute the anticipated break-even sales, and this would be our fixed cost of 765.40 plus the 22.96 million, the increase that we expect, divided by 111.80, which lets us know that we would need to sell 7.05 million barrels. All right, so that was my fault. As we see here, this should be 111.80. All right, so this brings us to the next step. Here it's asking us for a unit cost analysis. So here we see Crown Trophies Inc. uses a job order cost system for determining the cost to manufacture award products, plaques, and trophies. Among the company's products is an engraved plaque that is awarded to participants who complete an executive education at a local university. The company sells the plaques to the university for $75 each. Each plaque has a brass plate engraved with the name of the participant. Engraving requires approximately 30 minutes per name, and properly engraved names must be redone. The plate is screwed to an oak backboard, and this assembly takes approximately 6 minutes per unit. Improper assembly must be redone using the new oak board. And during the first half of the year, the university had 2 separate executive education classes. The job cost sheets for the 2 separate jobs indicated the following information. So here we have job 501, and then we have job 811. So the question is asking us, why did the cost per plaque increase from $25 to $28.02? And based upon the unit cost, what is an area of concern for Crown Trophies? So as we look at this information here, right, let's make it a little smaller so we can see both. We look at the information, we see the wood and the brass, is $7.50 per unit. There's no change. The prats is the same, $4 a unit. The engraving labor is the same, $20 per unit. And then we see our assembly labor is the same, $15 per unit. And our factory overhead is $3 per unit per hour, right? So as we consider this information and we see everything that's taken place, one thing we can see is that for the first job, we manufactured 75 units, and for the second job, we manufactured 85 units. So that obviously can have an impact. And then in addition, we see that the engraving obviously took more time. And again, this is ultimately because there's more jobs that need to be created. So therefore, why did our cost per plaque increase from $25.47 to $28.02? In this case, there was more labor and materials needed for the second job. There was no increase in the material costs, it remained the same. There was no increase in labor costs, and there was no increase in overheads allocated, but more labor and materials were needed because we manufactured more units. And for B, Based upon the unit cost, it's asking, what is an area of concern for crown trophies? So one thing that we should consider, one thing we should think about is maybe engraving, right? Because obviously, if it takes us about, here it lets us know engraving takes 30 minutes per name. So each plaque, as we know, has a brass plate engraved with the name of the participant, and the engraving takes about 30 minutes. So any improperly engraved names must be done, and the plate is screwed to the oak backboard. So considering this, the engraver did not meet expectations because there's more work that needed to be put in order to engrave the unit. So therefore, the engraving is an area of concern. Here we just have a few more questions. It's asking us, a mixed cost has a characteristic of both a variable cost and a fixed cost, and this is true. The next question is asking us to work on the high-low method. And on the high-low method, we know that this is essentially a cost estimation. And with the cost estimation, we can determine both the fixed cost and the variable cost. All right, so we know the formula as follows. Is as follows. Highest cost minus the lowest cost divided by highest units minus the lowest units. And this gives us our estimated variable cost per unit. All right, so in a previous problem, it asked us for the fixed cost, and this problem is just asking us for the variable cost per unit. So here we see that our highest cost is September, 5,000, and our highest units, 24,000. Let's try this again. All right, September is our highest, and July represents our lowest. All right, so 5,000 minus 2,000, that gives us 3,000, divided by 24,000 minus 12,000, which gives us 12,000. So in this case, our estimated variable cost per unit is as follows. 3,000, which represents the highest cost of 5,000 minus the lowest cost of 2,000, divided by our highest units of 24,000 minus our lowest units of 12,000, which gives us 12,000. So therefore, based on this high-low method, the variable cost per unit is 25 cents per unit. Here it asks us to calculate the break-even sales in units when fixed costs are 225,000, the unit selling price is 100, and the unit variable cost is 40. So as we know, our break-even in sales is as follows. And here we have our fixed costs divided by our unit contribution margin. And how we calculate this is as follows. The fixed cost, as we see, is already given, 225,000. And our unit contribution margin consists of our selling price minus our variable cost. So in such case, we have a selling price of 100 and we have a variable cost of 40, which gives us a unit contribution margin of 60. So we transfer this up above, 225,000, which represents our fixed cost and our $60 unit contribution margin. And based on this information, our break-even sales in units would be as follows: 225,000 divided by 60. So therefore, we need to sell 3,750 units. Here it says the variable cost per unit remains constant with changes in the level of activity, and this is correct. So if we have $2 per unit, if we sell 1,000 units at $2 per unit, our total variable cost would be 2,000. If we sold 5,000 units, our variable cost is still 2,000, but we see our total variable cost changes. So one thing that we see, our total variable cost changes with the level of activity. However, the question is asking about our variable cost per unit, which in this case is $2. So whether we sell 1,000 or we sell 5,000, or whether we produce rather 5,000 or 2,000 or 1,000, the cost per unit of $2 remains the same. What does change is our total variable cost. So therefore, this answer is true. Variable cost per unit remains constant with the changes of level of activity. What does change is the total variable cost. So this brings us to our next problem. Here it's asking us for the margin of safety. So it says Organic Healthcare Products Inc. expects to maintain the same inventories at the end of year 2008 as at the beginning of the year. The total of all production costs for the year is therefore assumed to be equal to the cost of goods sold. So with this in mind, the various departments heads were asked to submit estimates of the costs for the department during 20-year 8. A summary of these estimates is as follows. So in the first column, we have our estimated fixed costs. And then the second column, we have our estimated variable cost. So we have a total fixed cost of 24 million and a total estimated variable cost of 15 million. So with this problem, it's asking us, it is expected that 400,000 units will be sold at a price of $25 per unit. Maximum sales within the relevant range are 500,000 units. So the first part of this problem is asking us, what is the margin of safety? So with our margins of safety, we essentially need to determine what is our break-even unit sales from our current sales. So here we see, in order to determine one, it's our break-even sales. So current sales minus our break-even sales. So in such case, in order for us to determine, here we know that we expect we're going to sell 400,000 units. So the first problem is asking us for units, the second dollars, and the last a percentage of sales. So for question one, our current sales would be 400,000 units. And now we need to determine, well, what would our break-even sales in units be? So we know that our break-even formula equals fixed costs divided by our unit contribution margin. And our unit contribution margin is our sales price minus the variable cost. So based on this information, it lets us know that they will sell it at $25 a unit. And the problem lets us know that our variable cost is $15. So based on this information, our contribution margin is $10 per unit, and our fixed costs are 2.4 million. So therefore, we get our calculator. We have 2.4 million divided by $10 per unit, which is our contribution margin. That means that our break-even sales are 240,000. So therefore, our margin of safety in this example is our current expected sales of 400,000 minus our break-even sales of 240,000. So therefore, our margin of safety in units is 160,000. So now part 2 is asking us, what is the margin of safety in dollars? So in this case, it would be our current sales in dollars minus our break-even sales in dollars. So based on this information, we're using the same set of information. 400,000, which is the expected sales, multiplied by $25 per unit, as the information lets us know here. And then from there, we subtract our break-even sales in units. So it would be 240,000 multiplied by 25. That would give us 6 million. So therefore, 10 million minus 6 million gives us a margin of safety of dollars of 4 million. All right. And another way that we can calculate this is that we see that our margin of safety in sales is 160,000 units. So we can also do 160,000 multiplied by $25 per unit. So that would be an easier way to determine the dollar of sales, our margin of safety for the dollars of sales. We would determine our margin of safety in units and multiply it by the selling price, which would give us 4 million. All right, and now the last part of the problem, it's asking us to determine the margin of safety expressed as a percentage of sales. So therefore, we would simply divide our margin of safety in units divided by our estimated unit sales. So in such case, our 160,000, which represents our margin of safety, divided by our estimated units of sales, which would give us 40%. So it would be our margin of safety divided by our estimated units of sales. All right. So I know this is, a new concept, but for the most part with the margin of safety, just keep in mind is the current sales, which is given here, minus our break-even sales, which we've calculated up above. We know the break-even formula is our fixed cost divided by our unit contribution margin. And our unit contribution margin is our sales price minus our variable cost. So therefore, we divided our fixed cost of 2.4 million by $10, and we got break-even sales of 240,000. We subtracted the break-even sales from the current sales, and this gave us margin of safety of 160,000 units. For our margin of safety in dollars, we multiplied our expected selling units of 400,000 by $25. That gave us 10 million. And we subtracted our break-even sales in dollars, 240,000 units multiplied by $25 a unit. That gave us 6 million. So 10 million, our current sales in dollars minus our break-even sales in dollars of 6 million gave us a margin of safety of 4 million. Another way we can calculate this is our margin of safety in units of 160,000 multiplied by our selling price. And lastly, our margin of safety as a percentage of sales would be our margin of safety which we calculated up above, of 160,000 divided by our estimated units of sales, which is 400,000. All right, this brings us to our next question. Which of the following are the two main types of cost accounting systems for manufacturing operations? So we know that the two main are essentially our job order cost and our process cost systems. So B would be our correct answer. Now we have this example, recording factory labor costs. Here we see the weekly time records indicate the following distribution of labor hours for 3 direct labor employees. We have Eva Levitt, Micah Stone, and Travis Hendricks. And here we see there's job 560A, 560B, 560C, and then we have hours process improvement. So it lets us know their direct labor rate that's earned per hour by the 3 employees. And then we know that the process improvement category includes training, quality improvement, housekeeping, and other indirect tasks. So here's asking us to determine the factory labor costs transferred to work in process. So in order for us to determine this information, we need to factor in, hey, okay, what's the cost? So one key thing that we see here is hours for job 560A, B, and C. These all pertain to our direct materials in this case, our direct labor. So these hours pertain to our direct labor. And for our hours process improvement, this pertains to our indirect labor. So in this example, we're doing some simple math as follows. So here we see Eva worked 21 hours for job 560A, 14 for 560B, and 6 hours for 560C. So that gives us a total of 41 direct labor hours. Next, we have for Micah Stone, 14 hours for job 560A, 18 hours for job 560B, and 12 hours for job 560C, for a total of 44 direct labor hours. Next, for Travis Hendricks, he worked 11 hours for job 568, 13 hours for job 560B, and 11 hours for job 560C, for a total of 35 direct labor hours. So in order for us to determine the labor hours for each, for Eva, she worked 41 hours at a rate of $18 per hour. So the direct labor hours for Eva are as follows. So I'll do direct labor, which is 738 hours. And then next we have we'll actually do the same thing for Eva since we're working on it. So factory overhead, which is the 4 hours we see here, 3 hours for Micah and 4 hours for Travis. So we'll calculate it for each. So for Eva, it's $4 an hour at 18 an hour. That gives us a total of 72. For Micah, he worked a total direct labor hours of 44 hours at a rate of $25 an hour. That gives us a total cost of $1,100. And he worked 3 indirect labor hours at $25 an hour. That gives us a cost of $75 an hour. Right, it should be 78 for Eva. Double check the math. 18 times 4, 72. All right, and then now for Travis Hendricks, he had 35 direct labor hours at a rate of $21 an hour for a cost of $735. And he worked 4 hours at a rate of $21 an hour. So that'll give us 84 factory overhead hours. All right, so now the next step is for us to determine our total factory overhead and our total direct labor. So we'll start off with our direct labor, 738 for Eva, 1,010 for Micah, and 735 for Travis, which gives us a total work in process of 2,583. And next for our factory overhead, we have 72 for Eva, 75 for Micah, and 84 for Travis at a total factory labor cost of $231. All right, let me do the math again. So 21 plus 14 plus 6 times 18 an hour gives us 738, which is correct. Next for Micah Stone, 14 plus 18 plus 12, 44 hours times 25 an hour. Oh, had it wrong here, so it should be 1,100, so I'll fix that now. So it should be 1,100. So now when we add it, it'll be correct. So 1,100 plus 738 plus 735 gives us 2,570. All right, so that's how we would solve that. Again, the first three jobs are direct labor, and hours, process, and improvement represents our factory overhead. And then here it says, assume that jobs 560A and B were completed but not sold during the week, and that 560C remained incomplete. So based on this information, 560A is done, so it will become a part of finished goods inventory. 560B was completed, it would become a part of finished goods inventory. And 560C, that is incomplete, would be a part of our work in process inventory. So here we have this problem that's asking us about our margin of safety. So here it's telling us, if the unit selling price is 40 and the volume of sales is 3,500,000, sales at the break-even point amount to 3 million. And the maximum possible sales are 3,900,000. In such case, our margin of safety would be 12,500 units. So based on this information, it wants to know, is this true or is this false? So again, we need to keep in mind, in order to calculate our margin of safety, we know that our margin of safety is based on our current sales minus our break-even sales in units. So based on this information here, it's letting us know what the volume of sales are and the sales at the break-even point and whatever our maximum sales would be. So in order for us to determine this information, we again need to compare this information. So here we see our margin of safety. And in order to determine our margin of safety, as we pointed out earlier, again, we're looking at how much we anticipate to currently sell. And currently, we are anticipating that we are going to sell 3,500,000 units. So therefore, this answer, it says, okay, margin of safety and sales. So therefore, break-even unit sales would be subtracted from our current sales. So therefore, it would be 3,500,000 divided by 40 equals, so 3,500,000 divided by 40, That lets us know that it will be 87,500 units. And then we have the break-even sales of 3 million divided by 40, which would give us 75,000 sales in units. So therefore, based on this information, it's asking us, would the margin of safety be 12,500? So it would be 87,500 minus 75,000 would be 12,500. So the correct answer is true. So again, in this example, they gave us the margin of safety in dollars, but it's asking us for the margin of safety in units. So in order for us to determine the units, we divided the volume of sales of 3.5 million sales by $40. That gave us 87,500 units. And we did the same thing for our break-even sales. 3 million in sales divided by $40 per unit gave us units of 75,000. So our current sales of 87,500 units minus our break-even sales of 75,000 gives us a margin of safety of 12,500 units. So here, this question is asking us the difference between current sales revenue and sales at the break-even point is called our margin of safety, as we just reviewed. So our current sales revenue and sales at the break-even point is called margin of safety. And our margin of safety can be expressed based on units or sales dollars. All right, here we have this example. And it is asking us about determining manufacturing costs. So here we see Wagner Printing Inc. began operations on July 1st. Jobs 701 and 702 were completed during the month, and all costs applicable to them were recorded on the related cost sheet. Jobs 703 and 704 are still in process at the end of the month, and all applicable costs except factory overhead have been recorded. In addition to the materials and labor charged directly to the jobs, 680 of indirect materials, 2,400 of indirect labor were used during the month. So we have the summary form of the 4 jobs. So here we have job 701, job 702, 703, and 704. So we know 701 and 702 are totally completed. And then we need to determine, well, what is our factory overhead rate? So in order for us to determine our factory overhead rate, we know that factory overhead is always going to be a portion of our direct labor. So in order for us to determine our factory overhead rate, we essentially need to consider what is our rate. And how do we determine our rate? We determine our rate as follows. Factory overhead divided by direct labor. So factory overhead cost divided by direct labor cost equals our factory overhead rate. So if we use this example, our factory overhead is 1,485,000 divided by 2,700. And that gives us a factory overhead rate of 55%. If we do the same thing for job 2, 770 divided by 1,400 gives us 55%. So us knowing this information is going to help us as we solve for job 703 and 704. So this problem is asking us for part A, what is our direct materials used and transferred to work in process? So all we simply need to do is add up the direct materials from all jobs. So therefore, Here we have 7,080 for job 1, plus 3,010 for job 2, plus 10,200 for job 3, and 2,040 for job 4, which gives us a total direct materials of 22,630. So now it's also asking us for our indirect materials. As it relates to the indirect materials, there's no math that needs to be done. That information is given. We have 680 for indirect materials and 2,400 for indirect labor. So 680 for indirect materials, and we have 2,400 for indirect labor. So we can input that information now. So now the next step is to determine the direct labor. So we do the same thing. We add our direct labor for each job. So for job 1, it's 2,700. Job 2, 1,400. Job 3, 3,000. And job 4, 400. So we have total direct labor of $7,500. So now for part C is asking us, what is the factory overhead applied? So we can essentially go back and we can, for job 3, we can multiply 3,000 by 55%. We can multiply 400 by 55%. But an easier way to do such is, hey, we just calculated our total direct labor, and we know that our factory overhead is 55% of our direct labor. So therefore, 7,500 multiplied by 55%, that lets us know that our factory overhead is $4,125. So again, we factored in what our factory overhead rate is, and in this case, it is 55% of direct labor. So we simply multiply our total direct labor by 55%, and that lets us know our factory overhead. So now if we scroll up, the problem is asking us, what is the total for the completed job? So we know that job 1 and job 2 were completed. So we add the total for job 1 of 11,265 plus the total for job 2 of 5,480. So therefore, the total of the completed jobs, 16,745. So 16,745. And then here it says, assume that in addition to indirect materials, which is 680, and indirect labor of 2,400, factory overhead of 1,200 was incurred. So now we determine what the actual factory overhead was. Indirect materials of 680 plus indirect labor of 2,400 plus other factory overhead of 1,200. That gives us 4,280. So this is how much we actually spent, 4,280. Versus how much we estimated we will spend. So we estimated that we would spend 4,125, but we actually spent 4,280. So when we compare the two, how much we actually spent versus how much we did spend, we see that we spent $155 more. So therefore, it was under applied. We estimated we would spend 4,125 when in fact we spent 680 for indirect materials, 2,400 for factory overhead, and 1,200 for factory overhead. So we spent 4,280. But we only budgeted for 4,125. So therefore, we spent $155 more. So therefore, the factory overhead was under applied. We budgeted for less than we actually spent. All right. So this brings us to our next question, break-even sales. So we know that with our break-even sales, break even in units, it is our fixed costs divided by our unit contribution margin. And our unit contribution margin, as we know, is our sales price minus our variable cost. So in scenario A, we have a current selling price of $210, and we have variable cost of $170. So in this case, our unit contribution margin is $40. And all right, UCM. So based on this information, we have fixed costs of $360,000 divided by our unit contribution margin of 40. So therefore, our break-even sales in units, considering the current selling price and the current variable cost, is as follows. 360,000 divided by 40 equals 9,000 units. So now it's asking us to compute the anticipated break-even sales in units, assuming that the unit selling prices increase and all costs remains constant. So here we have a proposal to increase it to 230. So if we were to increase our selling price to 230, our variable cost remains the same. So now instead of a $40 unit contribution margin, our unit contribution margin would be 60. So therefore, 360,000 divided by $60 would give us a total break even as follows. 360,000 divided by $60 per unit. So therefore, our new break even in units would be 6,000 units that need to be sold to break even. So again, just keep in mind when we're dealing with the break even, it is the fixed costs divided by the unit contribution margin. And the unit contribution margin is our sales price minus our variable cost. In the first example, A, it says compute the current break-even sales. So we use the current selling price, where it says currently it's selling for $210. And in part B, we use the increase in price of selling price, which we see here, increase the unit selling price of $230. So A uses the current sales price, B uses the proposed increase in price. All right, so here's asking us, which of the following is most likely to be a product cost? So we know that we have product cost and we have period cost, and our product cost consists of our direct materials, direct labor, and our factory overhead. And our period cost is any selling, general, or administrative expenses. So here we see advertising for a particular product. This would be a period cost. Salary of the company receptionist would be a period cost. Drill bits for drill press used in the plant. This seems like a material, but let's look at D. D says salary of the vice president of sales. So this would be a period cost. So C would be our correct answer, is this makes up direct materials. And this brings us to our last question. Which of the following statements is a difference between financial accounting and our managerial accounting? So as we discussed earlier, managerial accounting is not governed by GAAP. And the key reason is because managerial accounting is just putting together information for management to make decisions based on information. So based on this information, here we see, we'll go through the answers. Financial accounting focuses on providing information for internal use, whereas managerial accounting focuses on providing information for external use. So A is incorrect because financial accounting is used externally and managerial accounting used internally. Here it says, financial accounting has a subjective approach, whereas managerial accounting has an objective approach. Okay, we'll come back to this. Here it says, under financial accounting, reports are prepared and as and when management needs them, whereas under managerial accounting, reports are prepared on a monthly basis. This is incorrect. D, under financial accounting, reports are prepared using GAAP. This is correct. Whereas under managerial accounting, information that is useful to management for its decision-making is not recorded using GAAP. So D is our correct answer. Financial accountant is subjected to GAAP, and managerial accounting is not subjected to GAAP. So this brings us to the end of the review for questions for Chapter 9, Manufacturing Accounting, and Chapter 10, Cost, Volume, Profit Analysis.